Today I have 5 must-know price action trading secrets for you, and this is going to really enhance the way you look at charts and deepen your understanding of price action. So the first one is the unsustainable fakeout reversal. What does this mean? And when we look at this chart, we can see that the market has been alternating between downtrend and uptrend and downtrend. And something very interesting has happened here on the right-hand side. This is very, very common. You will see sometimes that in a mature downtrend. What is a mature downtrend? A trend that has been already trending lower for quite a while. You can see we have multiple waves up and down, and then you see suddenly out of nowhere seemingly the market is making such a huge breakout move here. You can see within 2-3 candles the market has been moving lower past the previous low, and this for some people may look like a downside continuation. However, trading a downside continuation phase after such a mature downtrend is already to begin with a lower probability trade, and even more interesting afterwards. What happens here? First of all, you can see here at the downside we have a fake out. The market, after this big push, tried to make another fake out and immediately got reversed here back higher. So you can see this green candle is one single green candle here, and the market shot back up above the previous low where the previous breakout has started. And now you can see what we have here is a breakout buildup. So you can see the market is really sticking to this trend line here. You can see we can further extend the swing highs here. So we have now a very strong resistance level. We have resistance, resistance, resistance. If we would extend it to the left, you can see there's a lot going on here in this area. So the market is clearly moving away here from the lows. This breakout attempt is unsustainable. It didn't work. The market is back here. So this has really shifted the focus from downtrend to now leaning more towards an uptrending oriented market. And the trading plan for something like that would be you simply wait for a break or a break and retest of this level and then initiate a long. So this can be a really great starting point for your price analysis. And if you see something like that coming together, then this is a good idea to start looking for longs. You can see the market afterwards really traded higher for a long time. This is where the market rolled over from a downtrend, then here to the uptrend on the breakout. We could, for example, add an EMA here that would help us with riding a trend. As long as the market is trading above this EMA 50, you would be holding on to your winning trade. You can see a little bit after the market not only broke the 50 EMA, but also now is giving us a head and shoulder reversal pattern. So at this point, we don't know is the market really going to go lower, but if you are long, then it's a very good idea to consider taking profits, maybe partial profits, or at least trailing your stop loss much, much closer, because this is not a high probability pattern you want to see when you're in a long position. Next, we're going to take a look at the exhaustion breakout signal, and this is one of my favorite patterns. This is a continuation pattern, and what you see is the market went from uptrend. Here we have a double top, then downtrend, and after the downtrend reversal, you can see this is the first bearish trend wave. It is common then to see the market go back and forth. So a trend doesn't just unfold in a single move downside, but there are those ups and down waves. We call them impulse and corrective waves. And if you see that the market has rolled over with such a nice distribution phase, then the first impulsive wave, it can be a very profitable trading strategy to wait for correction wave 1, which is the first pause in such a new trend. And especially if you can see such a pattern, this may be a high probability trading scenario. What does it mean? It shows that the market made here its lowest low, tried to rally higher, but the bears kept coming back earlier and earlier. You can see we didn't even come close to the previous point, so not a lot of bearish pressure. Afterwards, the market reversed back into the low, tried to make another bullish run, but at this point you can see not even coming close to this high here, and then the market is really stuck to the level. It's called exhaustion because you can see from here to here the market is not even able to come close, so the bulls are really withdrawing from this market, and it really shows a lot of bearish pressure. We could add, for example, a higher time frame moving average or a long-term moving average. The EMA 100 here gives you a very good indication. As long as this market is generally trading below this moving average, you're leaning more towards the bearish side. So all taking together, the distribution, wave 1, first corrective wave, the exhaustion, the fact that the market is staying below the moving average, and here this exhaustion is pointing towards more downside. And this is exactly what happened. You can see the market broke out, really moved lower quite a bit. Where did it move into? Into the previous low, so probably some supply and demand in here, and that is where it would have been a wise idea to take profits. Now we're going to take a closer look at accumulation and how does it lead to a trend breakout. So what we have here is a market that was in a downtrend, moved lower, steadily, lower lows and lower highs, until here is where something is changing. First of all, we get a very decent price divergence. So if you add a stochastic, an RSI, MACD, any momentum indicator, basically you will get a divergence here. The market is weakly moving lower. At the same time, we are now trading here underneath this flip zone. Previous support turned into resistance and twice. Also, what we have here is a higher low. So the market seems to be showing a lot of signs that, first of all, the bearishness is fading and bullishness is slowly building up. When you see that the market is trading back into such a flip zone repeatedly, instead of just making lower lows and lower highs, which is what it did previously, this is already a very strong signal that the downtrend may be over, and we should get ready for a potential reversal. The trading plan would be to wait for a breakout, break and retest. We really want to see that this level, previous resistance here, is going to turn into support and provide us another higher low. This would really add a lot of context. And this is what happens. You can see the market moved higher, moved back into this level and retested it very, very precisely. So at this point, we have a lot of things on our side. If we want to go long, we have a lot of positive confluence. And I also made this tunnel here. So as you can see on the top left, those are two moving averages. Both have the 50 period. One is applied to the high, which is the green one, and one is applied to the low, which is the red one. And this tunnel can never cross. And the way to use it is to have an additional confirmation when riding a winning trade. What I've seen in the traders that I have mentored over the years is that staying in winning trades and riding winners is very challenging emotionally. So this is an objective way to help you stay in trades long enough, or at least longer than many traders usually would. And the way to use it is, if you go long, for example, here on the break and retest, you may use this moving average to trail your stop loss below and also to use it for an exit signal. So you can see here the market traded higher, it dipped into the tunnel, that's all right. The tunnel will sometimes act as a support resistance tool. And then here, once the market really completely broke below it, that's where you may have gotten out. If you don't apply a trailing stop loss, then you would have been out previously. And then the market rolled over, interestingly, to the other side. You can see we have here the triple tap. I made a few videos about a triple tap. It's basically just 3 taps consecutively, and each tap shows a little bit more weakness in a trend, especially when it happens in such a mature trend context. It is often a reversal signal. Then the market breaks through the moving average tunnel, retests it from underneath. Here is another flip zone, just like what we've seen here, support turned into resistance. Here we have resistance turned into support, and on the break it stays as resistance. We have the exhaustion breakout, what we've seen previously, and then here the market collapsed, moved lower. Now we're going to take a look at the multi-time frame trend exhaustion. So we're starting on the daily time frame, and here we can see something very interesting. A lot of things are coming together. First of all, the market is in a long uptrend. And the longer a trend goes on, the higher the likelihood that it may end or even completely reverse. However, obviously a trend can go on for a long time, and we need to have a lot of solid reasons and confluence factors that the market first shows signs of exhaustion and then maybe even reversal. So on the higher time frame, we have a divergence here. The market made a higher high, but not very convincingly. Here it seems like we have a pin bar first and then an exhaustion candle. So you can see from the pin bar, the market gapped higher and then closed lower. A very strong candle close. You can see the market is showing us a lot of weakness here on the bearish side. So a few very interesting facts on the higher time frame. On the lower time frame, we can see we have another divergence. So we not only have our higher time frame divergence, but also our lower time frame divergence. We have very nice reaction here at the flip zone. So previous support here is turning into resistance. The market has also finally rolled over below the moving average, which is another bearish signal. The market has crossed below 2 swing points here, or 2 lows to the downside, which is a good bearish signal as well. So we don't want to get into a short right away. Sometimes what you will see is the market is coming back to perform a retest, and as a retest trader, this is what we want to look for. And this is what you get afterwards. The market is making a little bit of a bearish move. You can see this is a correction wave. As long as the market stays below the moving average, that's another positive confluence factor. So at this point, it may have been a good idea to initiate a short. Some traders, if you are a little bit more conservative, you wait for the market to make a lower low. The stop loss generally is placed here above the moving average, also above the flip zone. So you have a few layers of protection between the current price and the stop loss. And that's generally a wise approach how to place stops. And this is what happened afterwards. You can see this is the retest. The market moved lower, broke the lows, and then accelerated here to the downside. Here is where we have a double bottom. The market is also trading aggressively into a previous high. So at this point, of course, we don't know if the market is going to reverse, but at this point, it is maybe a good idea to think about scaling out of the trade, maybe even completely closing the short side, and then wait for the next move. I've talked already quite a bit about Confluence in this video, and Confluence basically means that you have multiple signals, tools, concepts of technical analysis that point towards the same trading idea. And in technical analysis in general, the best trades happen when you have as many positive confluence factors that show you a similar idea. So here we are on the higher time frame, and a lot of things are coming together. First of all, the market is trading back into this huge high here that led to a very strong reaction. We have a divergence. We also have here a fake out pattern. So the market pushed into the high, and then the next candle here closed lower, giving us the fake out, giving us the divergence, and we have the confluence factor that the market is trading at a high. So on higher time frame, it makes sense to have a little bit more of a bearish bias. So we would then go to the lower time frame and see what is the situation. We see the situation is very interesting because we have a nice support level here. We also see that the market is showing exhaustion, so we have lower highs. So the market is really aggressively trading into this low, and it's also here the round number where the market is currently trading at. So it would make sense for a trading plan to look for a break and retest opportunity. We want to see in a downtrend that the market is making lower lows and lower highs. Generally, we would like to see that correction waves test previous lows or highs and then reject them. So trading a pullback approach into such a previous breakout area would be ideal. You can see the market did have here a move lower, so this is how you could get into the trade. What you see is that the market made another lower high. In this case, the breakout happened. Your stop loss could be here. You want to put the stop loss at least above the last swing high, add a little bit of volatility buffer. So never put the stop loss just at a high because they get retested quite frequently. And so you put your stop loss a little bit out of the traffic. And for targets, you can look left and we see here's the last accumulation zone. We want to put our target a little bit above that so that if the market reacts strongly to the level here, we are out before the market may turn around. And you can see this is what happened. The market gave us another retest here, made more lower highs. At no point was our stop loss threatened because we put it out of the way. And to the downside, you can see the market moved into the low, gave us a little bit of a reaction, and then come back here to the level. So very interesting case study. It starts all on the higher time frame where we look for what is our general idea. Does it make sense to look for longs or shorts? And then we go to the lower time frame where we develop our trading plans.